This is Edward Talisi for Chelsea Global Advisors and the CQF Institute. It's November 14th, 2014, and welcome to our periodic updates about market dynamics and capital markets throughout the world. Since we last spoke, risky markets have behaved very well and continue to trade higher and take out all-time high, particularly in the US and to a lesser extent in Japan, whereas European markets are still lagging somewhat, even after the European Central Bank and the European Banking Association released the much anticipated stress test for the European banks, which basically gave a healthy check to the European banking sector. To repeat our three key pillars of looking at risky assets, we're all firmly much in a sort of sweet spot for markets to continue to trade well between now and the end of the year. Those three pillars, to remind everyone, the first pillar is earnings and earnings growth. We just came through the third quarter earnings season where U.S. companies reported on average across all 500 S&P companies earnings growth anywhere between 6 to 7%. Revenue growth for those same constituent companies were around 3 to 4%. So earnings growth is extremely respectable and healthy. Certainly was for the third quarter of 2014. Liquidity, as measured mainly by central bank policy actions, remains extremely accommodative, even though the Fed has announced the ending of their bond buying program. However, the European Central Bank and the Bank of Japan have clearly taken up the baton in adding tons of liquidity to the markets. So the second pillar is generally firmly in place and supportive of risky assets. Our third pillar that we always talk about is interest rates. Around the world in developed markets, interest rates remain near historic lows. 10-year U.S. Treasuries are about 230. They're about 80 basis points in Europe for 10-year bonds and have been hovering anywhere from 45 to 50 basis points for 10-year JGBs. There's really nothing on the horizon, certainly no inflation scare that is going to move interest rates off these all-time historic lows anytime soon. So the three pillars, very, very supportive of risky financial markets between now and the year end, and that's why I recommend that investors that have exposure to risky assets pretty much stick with their investment plans that I have laid out. Since the bottoming of the market in the middle of October, the S&P, I think, hit a low of around 1792. It's up more than 17%, and that's in just one short month. So the market is really bounced very strongly from the bottom. The VIX, which everyone recalls in mid-October, spiked much higher and was trading in vol points around 26, is now back very close to the year's all-time low, which is around 10 index vol points. I think today it closed at around 12. The one point, or the one area where I do think it's worth investors looking at as a potential opportunity is the high yield market. So as equity markets have recovered nicely from mid-October and are way above those lows and at all-time highs, the U.S. high yield market is still more than 100 basis points wider than it was at the all-time tights from the earlier part of this year. So I do think high yield market for investors that have cash in the U.S. is an attractive opportunity. Before moving on to the charts that you have in front of you, I just wanted to mention a piece of research that I found, that was mailed to me by one of my favorite research outfits. They're based in Hong Kong. And they came up with something that I thought was very intuitive and appealing to way to look at potentially investing. Their idea is that stocks throughout the world can be bucketed into three groups, and those three groups are companies that are very good at rational reorganization of supply chains. I think Walmart is probably a good example of that. Amazon is another good example of that. Other companies could be bucketed in where they are very good at disruption and disruptive technologies. Clearly Google would come to mind on that, maybe even Facebook and Twitter. And lastly, some companies could be bucketed into what I would call scarcity assets and trying to make money from extracting energy, gold or oil to make money from. And I think right now what's really shocking, if you think about what's going on in the market, is that last bucket is companies that really look to exploit scarcity assets like gold gold miners and oil companies have really been hammered as lately. It would be very interesting to see how that plays out over the near term. But I did think it was worth mentioning to everyone. What I wanted to do now is talk about two quick charts. As you know, and I've mentioned many times myself and for my clients, I'm not really a fan of market timing. I generally believe that over the long term, investors are best served by coming up with a strategic asset allocation and sticking to that and let the market's natural drift higher and risky assets play to your favor. However, market timing still is very popular among many investors and many active managers. But I do think this year illustrates a very good point where you could get severely burned if you overly active in the markets, where I don't think a lot of people that sold in mid-October at the bottom were quick enough to sort of go back and get long in the markets to see the all-time highs. So the sort of strategies that I like if you are believing in market timing is to sort of stick to this 4-quadrant approach where the y-axis is sort of what's going on in the markets or in the intensity or the impact of the move, and the x-axis is here is how soon do you really need cash. I think for most people that are lucky enough to be in a position where they don't have an immediacy need for cash, but the market has made a very, very big move, it probably does make sense to balance exposure. And this is sort of where it would dictate that if equity markets sold off a lot and you didn't really need the money anytime soon, you should probably rebalance away from bonds and into equity. So this quadrant here sort of suggests that you buy the underperformers or sell the outperformers. And that's generally what I subscribe to myself. Some other points here, I think if you don't really need money straight away from your investment portfolio and the market impact of what's going on, volatility very low, probably means you shouldn't really do that much. You should just monitor developments and sit tight. And I think this is the one area where investors have a lot of trouble of sitting on their hands and not trading unnecessarily. So, but I would recommend just to sit tight if you don't need the money and the market's not moving that much. If you do need the money, you may have a down payment coming for a house, or you may have big tuition bills coming up, and the market has moved huge. You most likely should exit the market and stay 100% in cash. The last thing that you want to do is really risk that down payment or risk your children's tuition by staying in the market if you have an immediate need for cash. So you probably shouldn't have been in risky assets in the first place in quadrant 1 if that was the case. I do think also that if you do have an immediate need for cash, say you intend to buy a house 6 months or a year from now, but the market is not really doing that much, I think a good strategy is to take advantage of the low volatility because the market's not moving much, and to engage in what I describe as contingent strategies, which means to use the volatility, the low volatility, to buy attractively priced calls to take advantage of the upside of the market, or puts if you think that the market is going to go down. I think favoring this type of approach will really help you avoid catastrophic mistakes of entering the markets at poor times, like a lot of people did in October of this year, and really reduce trading expenses. Thank you very much. This is Edward Talisi again for Chelsea Global Advisors and the CQF Institute. And I encourage everyone to go check out the websites for both CQF and for Chelsea Global Advisors. Thank you very much.